D.K. Joshi, Director and Principal Consultant at CRISIL, joins us right now on the show. Good having you, Mr. Joshi. Thanks so much for joining in. You would have read the announcements that came in with regards to the new gold import norms by the RBI. How impactful do you think these would be in terms of reining in one, the free fall in the currency, to the CAD, so on and so forth? They are obviously aimed at reducing the import of gold.
Well, I think these measures are not the best way to deal with correcting the current account deficit. I think the issues are much more deeper. But yeah, I think in the short run it does. I think it will curb gold imports, which anyway we believe would have been lower than last year because the gold prices have declined so sharply. So even if you import the same amount of gold as you did last year, your gold import bill in dollar terms is going to be much lower because of the decline in prices. So I think so in the short run it might help, but I think I see it as a temporary move, and I think once there is a sign of some impact on imports, and I think current account stabilizing, I think these measures need to be taken off. I mean, we've actually removed restrictions in the last couple of years. I think so. This is, I think, trying to deal with the emergency situation on the current account side and on the rupee side. So it will help a bit in the short run, but I think it's like a band-aid approach. I mean, it's not the solution to the high current account deficit.
Can it have an impact on the currency as well? Because one of the norms, if I'm not wrong, also stated that exporters have to reduce the remittances that come in the cycle that they were in from 120 days to 90 days. So money that used to take 4 months will now have to come in 3 months. That would probably mean more inflow of dollars for these export-oriented units.
Well, yeah, I think to some extent it might help, but I think eventually the value of the dollar will also depend on the global risk appetite and liquidity. And I think that's where the Fed comes in. So I think we'll have to keep watching developments in the other parts of the world, particularly US. I think as far as domestic vulnerability is concerned, I think on the external account it's quite high. So even a small shock from anywhere can cause ripple in the currency. So this is only going to correct it somewhat. I mean, it's, as I said earlier, it's neither a durable solution for curbing current account deficit nor for bringing stability in currency. So this will, in the short run, will create some strengthening bias in the currency. I think that's it.
Right. Afternoon, Mr. Joshi. If you could also walk us through, I mean, given that you said that this was a bit of a band-aid measure with respect to curbing the overall deficit, can you run us through what kind of measures you believe should have been implemented?
Well, I think, yeah, sure. I think in the short run, there's nothing much you can do. I mean, you have to endure. So I think that's why they came up with this band-aid kind of approach. But I think if you want to bring your current account deficit down to sustainable levels, I think you have to check your trade deficit. And I think trade deficit, a better way of checking it is not by curbing imports, but by making exports more competitive, and that cannot be done so quickly. So I think that's where you need to shift the focus. I mean, our trade deficit as a percentage of GDP, which was close to 3% in 1991, today is close to 11%. I mean, so we've been importing at a much faster pace than exporting. So I think somewhere we've lost the competitiveness of exports, and I think that unless you revive that, I don't see this getting corrected. The other, I think the why current account deficit is lower is because you have good remittances and ITS exports. I think those things are still cushioning us against the adverse impact of a very large trade deficit. So I think correction of trade deficit cannot be achieved, cannot be sustainable by curbing imports. It rather can be made sustainable by promoting exports.
Mr. Joshi, but for the month of... Right, go ahead.
No, please carry on.
So just wanted to know with respect to the overall trade deficit and where you see that headed, because for the month of June, it did narrow on account of the clampdown on gold imports. But going forward, what kind of numbers would you be working with?
Well, I think I would say that the trade deficit as a percentage of GDP in 2013-14 will definitely be lower than 12-13 because because one is that gold imports will come down, and second, I think the risk is from the oil side. I think suddenly the oil prices, which were benign, have started firming up. I think if our call on oil was that around 105, so if it averages around 105 this year, then I think you will see trade deficit to GDP ratio come down marginally. I think it won't fall below 10%, but I think somewhere it will be lower than what it was last year.
When it comes to the currency and the kind of movement we've seen, there has really been not that much stability despite certain steps that have been taken by the Reserve Bank. Do you think that the bottom line would be that more proactive steps need to be taken to recoup the forex reserves, issuing NRI bonds or sovereign debt offer? Those are some of the ready-made fixes?
No, I think those you'll have to do, because you cannot immediately curb your current account deficit. So what you can do in the short run is, I think, apart from what the government and RBI have been doing, is to open up the doors for more capital to come in. So I think that capital only comes in not only because you announce reform measures, but also if there is some durable action on the ground. So I think the reform measures announced. If I take you back to 2012. I think the rupee had depreciated quite sharply even then. I mean, and when the government announced a lot of reforms, particularly in the FDI segment, and also I think in setting the subsidy regime right. I mean, the oil prices were raised. I mean, so subsidy was cut down. I think after that you saw steady capital flow for quite some time. I mean, and so that pushed the currency rupee value up as well. So I think you need reforms to improve the sentiment, because a lot of capital flows also react to what kind of sentiment is there, and the sentiment is quite weak right now. So I would say that, yeah, I think you have to open the doors, and also at the same time do some reform measures, and I think back it up by activity on the ground. I think then you ensure that the capital comes in. Right now, I think we got in a lot of debt flows last year, but I think they were very fickle in nature. I mean, as we saw that the debt outflow was very sharp. So I think we should make sure that while trying to curb the vulnerability of high current account deficit, we should not create the vulnerability of excessive short-term debt, because I think that's where the movement has been. I mean, the proportion of short-term debt in the overall debt has been rising. So I mean, I would say that right. Yeah, situation is quite precarious at this juncture.
Great, Mr. Joshi, leave it at that. Thanks so much for joining in and giving us that perspective. Really appreciate you taking the time out.